We're at 3,000. We've been there the whole year. It's been a roller coaster. We were not disturbed by the activity in February. And as Mike pointed out, the fact that people are trying to pick apart the breadth of the rally is a positive for us. We look at the underlying advanced declines cumulatively, and they are at their highs. And very often over the course of this 9 years, the advanced declines have led the S&P higher, so we do expect new highs.
Stephanie, what's your view on the breadth, but also the sort of lack of significant volatility that we've seen?
Oh, I'm okay with the lack of volatility. I mean, there are plenty of stocks to find, but I think Mike hit on it perfectly, that this is a year of rotation, right? I mean, it's been the beginning of the year, we saw FANG lead and growth lead, and then we kind of saw the rotation to a little bit more cyclicals, and then most recently, it's been much more of a defensive rotation, and that's leading us. So staples, telecom, utilities, some financials, if you want to put that in the kind of the defensive bucket.
Too, yeah.
Healthcare, and that's actually also value, right? Value versus growth. That said, technology is still still accounted for 55% of the S&P returns year to date. So you can see why people are taking gains in technology, rotating around. I think U.S. is still a very interesting place you want to be because the economic growth is fine. It's not going to continue at 4.1%, but if you look at the components of GDP, if you look at the components of the non-farm payroll and the revisions, you look at what the consumer is doing in retail sales, manufacturing and business investment, you're looking at like a 3% kind of second half of the year GDP number. That's good enough for corporate earnings. That's good enough at 15.5 times earnings, which is the valuation, right? We have a nice and attractive valuation. That said, I don't think you want to ignore international altogether because I think the sentiment is so negative.
Well, that's the question. Is there more value internationally?
Well, you have stimulus too, right? You have the ECB, the BOJ, the Bank of China. China is also.
We've been talking about how the opportunity in Europe and elsewhere is supposed to be so much better. I mean, we were talking about the Larry Summers piece today in the FT, which basically tries to claim that basically all of the growth outside of the U.S. is actually a function, is what's making the U.S. grow. That's not as true, we think, today. But
I don't think it's as true today, but I do think you could look at the first 6 months of this year and say, what did companies benefit from? Massive tax cut windfall, as well as the one quarter in the last decade when you had all economies globally kind of firing at the same time, and that was filling up your order books. So that just means that there's this kind of big acceleration in earnings that nobody expects to continue, but I don't think you would say that the domestic economy performance has really been a matter of the global economy lifting it up. There's no way you'd say.
But at 15.5 times forward estimates, you're not asking a lot. You really aren't.
For a global.
For global, and also for even a deceleration in earnings, right? I mean, even if you don't grow 20-25% in earnings, you grow 10-12%. It's still attractive.
Ryan, do you prefer U.S. or overseas equities?
Right here, we'd stick with the U.S. over, Europe. Now, you talk about what do we know? Well, we know historically August and September are troublesome months, so volatility. Also, on August 31st, guys, this will become the longest bull market in history, at least since World War II. So late in the cycle, you see more volatility. But we just kind of building on the themes we just had, earnings and technicals. If you look at what companies are saying here, they've actually S&P 500 companies have increased the current forward 4-quarter forecast. Usually that drops 2 to 3%. So that's rare. So tariffs apparently are not impacting corporate America, a good thing. But building on the technical thing, we talked about the advanced decline line in the S&P 500, the NYSE, small caps, mid caps, technology, all those advanced decline lines are really strong. Yes, the worry is, 14% of the S&P 500 is made up of just 5 companies. You go back in history, though, that's about average. So to us, there's a lot of breadth. Fundamentals are strong. It's going to be a rocky ride, but we still think double-digit gains this year is very likely.